In this chapter, we're discussing about securitization, which is a very advanced topic, probably the most difficult concept in the entire book. So it's perfectly normal if you can if you skip this. This is asked at a very advanced level for finance students. This is for a fresher like you, most of you. This is not that important, but because it's a very important concept, at least if you know the basics, that will be very helpful. But even otherwise, if they ask in interviews, they can safely say you don't know. That will not be a negative feature. It's a very advanced topic. So if you don't understand what we're discussing in this chapter, please feel free to skip it. Okay. So securitization is a financial engineering. When we say financial engineering, it's a process of taking an illiquid security asset or a group of assets and transforming them into security. Liquid means, say in a stock market, there is this a stock of a particular company that is very in high demand. So you hold some shares of say Infosys or SBI or some good company. That stock will be having liquidity. It means people are willing to buy it. Okay, so the day when you need funds and you want to sell it, you can easily dispose of the stock. It is highly liquid. Okay. Then there are some illiquid stocks where there is less demand, and if you want to dispose it, it's not that easy. Okay. So that is the liquidity. It means how liquid means that you can dispose it off when you want, when you need funds. Similarly, in assets, there are liquid assets and illiquid assets. Assets like if you have cash, that is liquid, highly liquid. But you have say some building, real estate. If you sell it, you will get money, but that's not liquid. Immediately you won't get cash. Okay, there is this concept of liquidity. So in banks, when you speak of liquidity, there comes the concept of securitization, where we take this illiquid securities or illiquid assets, package them into a group of assets and transform them into security. So a typical example of this is something called mortgage-backed security. Okay, so this is a security where it's secured or backed by a collection of mortgages, and let us see the process involved here. First, a regulated and an authorized financial institution originates numerous mortgages. Okay, mortgages means home loans. They are secured by claims against the various properties in the mortgages purchase. Okay, so there's some 100 housing loans. Let us assume there are some 100 housing loans, individual housing loans, 100 loans given to 100 individual customers. Okay, so what this originator or the bank or the financial institution does is, it bundles together all these individual mortgages into a mortgage pool. Okay, that will be held in a trust. This will be the collateral for a security called MBS, mortgage-backed security. Okay, so we are creating a new security. So this is a financial engineering. Engineering means we are creating or we are transforming one to another. So here we are taking a bundle of securities and transforming into a single security. So we have these 100 housing loans. We are pooling them and creating a one single security called MBS, that is mortgage-backed security. So this security is backed by the security of this 100 housing loans. Okay, so this new security MBS can be issued to a third party company, financial company, like say investment bank, or it can be by the same bank that originated the mortgages. Okay, so this new security is created. As I said, this is backed by the claims against the mortgages assets. So this is a secured asset, and this security can be sold to participants in the secondary mortgage market. And this market is very high. Okay, so there'll be substantial liquidity. There are a lot of buyers willing to take this. Okay, because individually these had you marketed these loans individually, each of these 100 loans, those would have been illiquid. Okay, but because now we have packaged them into a large number of loans into one single security, they are liquid. Okay, and also this is a key point. At the time the mortgage-backed security is created, what the issuer will often do is they'll break that pool into a number of different parts, referred to as tranches. Okay, so you can you can structure this in virtually any way you like it. Say for example, 100 is a small example, but say for example there are some 10,000 housing loans. Now what the issuer can do is they can break that 10,000 into a variety of risk levels. Okay, they can be, out of the 10,000 there could be 2,000 housing loans of very high credit quality. These are people who are paying well, on time, prompt, good income level. Okay, then out of the 10,000 there could be some 6,000 which are of average credit rating. They are paying in time, but maybe they are defaulting or late payments, maybe late payment up to 1 month or or 2 weeks or something like that. Then they, out of 10,000 they could be like 2,000 of bad credit rating, people are irregular in repayments. So you can structure this entire 10,000 housing loans into tranches. Okay, each has a different risk level. Okay, so the people, when we package them into an MBS, the people who invest in these securities, these mortgage-backed securities, they'll typically invest in high credit rating instruments. But there are investors like, say for example, hedge funds, which we'll discuss in the coming chapter. They usually look at higher returns. So you get higher return by taking higher risks. So those people will invest in this low credit rating securities. So you can package them in any way you want. Okay, so you're bundling the securities into a high security, medium security, low security, like that, and selling to interested parties. So people who are not interested in taking risk, like pension funds. Again, we'll discuss about pension fund in the coming chapter. Those people usually will not take huge risks. So they want to invest in low risk securities. So they will invest in this tranche where there are high credit rated mortgage backed securities. Whereas people like hedge funds who want higher returns, they'll invest in this low credit rating mortgage backed securities. Okay, so what happens when an investor invests in this MBS? So it's essentially lending money to the home buyers or businesses. Okay, so it's a way for a smaller regional bank to lend mortgages to its customers without having to worry about whether the customers have the assets to cover the loan. So instead, the bank acts as a middleman between the home buyer and the investor market participants. Okay, so this type of securities commonly also used to redirect the interest and principal payments from the pool of mortgages to shareholders. So if they ask you in interviews what is securitization, is basically a process of converting existing assets or future cash flows into marketable securities. Okay, it's conversion of assets which individually may not be marketable into marketable securities. So what are the assets that can be securitized? Most of the loans, car loans, housing loans, even future cash flows like ticket sales, credit card payments, car rentals, there's a lot of financial engineering that can take place. So in a traditional lending process, a bank makes a loan, it maintains it as an asset on its balance sheet, collects the principal and interest, monitors whether the repayments are coming back in time. The entire thing from A to Z is the bank's headache. So this requires a bank to hold assets till maturity. Okay, so in a way, the funds of the bank are blocked in these loans, and if the bank wants to grow, expand, it will be having limitations. It needs additional funds from the market because these funds are blocked. So securitization is a way of unlocking these blocked funds. Okay, so take an example like an ABC bank. The loans which ABC banks has given are its assets. So this bank will be having a pool of its assets, and the funds are locked up because the bank has given loan to customers and they have to repay. Unless they repay, the funds are blocked for the bank. Now to free these blocked funds, what the bank can do is ABC bank can transfer this to a special purpose vehicle, SPV. Again, this is the concept we discussed in the earlier chapter. Please refer back. SPV is a special purpose vehicle. So this is a separate entity formed exclusively for the purpose of facilitation of the securitization process. Okay, and as we discussed earlier, the assets transferred to the SPV need to be homogeneous in terms of the underlying asset, maturity and risk profile. So we can bundle the securities in of a particular risk profile. Okay, and only homogeneous assets will be transferred to the SPV. So what this means, not only one type of asset like auto loans of similar maturity will be bundled for creating the securitized instrument. So you might have a situation where one bundle is auto loans of B credit rated customers, tenure of 20 to 24 months. So that is one bundle. So you have another asset like housing loans, maturity of 10 years, medium credit risk. So there will be this bundling of securities. Okay, so SPV will be acting as intermediary and which divides the assets of the originator into marketable securities. Then these securities issued by the SPV to the investors are known as pass-through certificates. So what are pass-through certificates? The securities issued by the SPV. Now the SPV is formed. The originator, that's the bank or the financial institution, has bundled them, formed a SPV. That's a special purpose vehicle. It has transferred all these assets to the SPV. The SPV will now issue something known as pass-through certificates. So to the investors. Okay. So the cash flows received from the obligors. Obligors are the original people who have taken the loans, the individual customers. So the cash flows which are received from them will be passed on to the investors who invested in these PTCs on pro rata basis. Okay, and of course service charge will be deducted. So the investors who invest in these pass-through certificates can be banks, mutual funds, pension funds, hedge funds, governments. Okay. So in India, only qualified institutional buyers who possess the expertise are allowed to invest in PTCs. And in order to facilitate this wide distribution of these instruments, evaluation is of utmost importance. So this is carried on by rating these instruments. Okay. So the rating agencies rates these instruments on the basis of asset quality and not on the basis of the rating of the originator. That's important. So the bank can be a very high rated bank, good bank, but the underlying risk profile of the customers can be very different, ranging from low to medium to high. Okay. So these securitized instruments are rated not on the basis of the originator, not the bank, but on the underlying asset quality. Okay. So it might happen that a particular group of assets they have a credit rating that is much better than the bank. It can happen. So the administrator of the servicer is appointed to collect the payments from the obligors. Obligors are the people who have taken originally the loans. So the servicer follow-ups of the defaulters. It may use legal remedies against them. Okay. So in the case of ABC, SPV can have a servicer to collect the loan repayments from people who have taken the loan. So normally the bank will carry out this activity, but once assets are securitized, these assets are removed from the bank's book and money generated to securitization can be used for other, say, expansion or for giving new loans like that. Okay. So I know this is a tough chapter. Even if you could understand 10 to 20%, that is more than sufficient. Securitization is a difficult concept to understand. Maybe if you can watch a couple of times, it will be more clear. But even otherwise, it's not that much important for you. So the questions you need to be prepared, and these are optional. Don't worry if you don't understand. So the basic questions at least you need to prepare are: what is meant by securitization? What is meant by mortgage-backed security? What are pass-through certificates? Do the rating agency rate the securitized instruments on the basis of asset quality or on the basis of rating of the originator? This is on the basis of the asset quality.